Hi, I'm Miguel from L1 Advisors. I'm here with Nick Rygiel, the owner and financial advisor at Ironclad Financial. Hi, Nick. How are you?
Pretty well. How's it going?
Good, good. Thank you for being with us. Tell us a little bit about your firm.
Sure. So my name is again Nick Rygiel. I'm the owner of Ironclad Financial. It's a registered investment advisory firm located in Bryn Mawr, Pennsylvania, right outside of Philadelphia. And I started this company less than a year ago. So I was with Merrill Lynch for about 11 years and decided that, I wanted to get into more technology. I wanted to get into more providing advice in some of these emerging areas. And crypto was one of those areas.
Excellent. And
And
are you doing anything on chain?
that's a great question. So of course, this is probably the reason why how we met was when I left Merrill. I was very excited to be like, oh wow, now I can get into DeFi and Ethereum and really get into some of the other emerging infrastructure. And of course, we all know what happened last year, and it really kind of spurred on this question of who should have control over people's assets. I mean, we talk about DeFi all the time, and yet then we kind of ignore the whole kind of functionality of it. We start just buying tokens as if that's the whole point of it. It's the actual kind of on-chain transactions. And I just couldn't find anything that would allow me to facilitate providing advice while still allowing the clients to maintain custody. So that's actually how I came about with L1. You guys were the first to really offer integration with Uniswap V3, and that really kind of piqued my interest.
So let's
So,
talk a little bit more about Uniswap V3. Can you tell us what you're doing on Uni V3?
sure. So the biggest part of I think any type of portfolio allocation or looking at how to kind of structure all the different what if scenarios is to kind of look at, well, what would happen if we enter another bull market? What would happen if we stay in this kind of sideways crab market? And what would happen if we hit a bear market? Well, depending on each client's kind of risk tolerances, they might have a portion of ETH, for example, that they're saying, you know what, I wouldn't mind having a strategy that's designed for more of this sideways market. And Uniswap V3 is perfect for kind of setting the expectations of saying, here is the limit that your ETH would turn into, let's say, USDC, and here's a limit that it would turn into full ETH. So if you're willing to buy more ETH at a lower price and you're willing to sell ETH at a higher price, then setting up a narrow band makes perfect sense. And so I've been using Uniswap as a way of generating yield to offset some of the kind of the what if scenarios of the like crab market.
And I mean, the people that are listening and watching this, some may be familiar with Uniswap V3, some may not. As somebody that has tried to set up Uniswap V3 position myself, sorry, it was a painful learning curve. There's a concept of impermanent loss, and I was hit by it. Can you explain the viewers what that is? And I think it's one of the reasons why you'd want to work with an advisor like yourself, who actually researches and makes sure that these bands are set up properly. Tell us a little bit more about impermanent loss and all the work that goes into kind of preventing that, or I guess hedging against it.
Right. So there's a couple ways to hedge. I mean, it's one, now we're getting into what kind of is available for U.S. citizens. And so that's always a question from a regulatory standpoint. And I would say that there's some platforms like Aave or even others that would allow you to, let's say, borrow against your ETH as a way of saying, if you want to have a number of ETH, let's just say like 100 ETH, you could basically borrow it against yourself. Mm-hmm. And then say, I'll take 100 ETH and I'll borrow, let's say, 50 ETH, and I'll use 50 ETH in a Uniswap. So that way I know, worst case scenario, I still will have that kind of allocation towards ETH without necessarily affecting what's happening in the Uniswap pools. So if I take a step back, when I talk about like Uniswap and liquidity pools, all we're basically doing is we're creating what's called an automated market maker. And what that is because everything's on chain, we don't actually have the ability to trade live time in terms of saying if somebody wants to buy ETH and somebody wants to sell ETH, they have to basically sell it into something else. We just think of US dollars, for example, but that doesn't exist on chain. So there's stable coins, and one stable coin that's very popular, and there's others, is USDC by Circle. And what USDC allows is a way of stabilizing a token that supposedly will track the US dollar. Now, does it do it 100%? No, but it's basically close enough to get to allowing you to trade something that will be closest to a stable dollar, if you will. And that then allows you to start doing certain transactions on chain. So in Uniswap, it allows you to trade one token for another token. If you have, let's say, ETH and you have USDC, you can add them into what's called a liquidity pool, and you set the terms for when you would want to purchase more ETH, which is basically the lower boundary of the trading band. So if you were looking at ETH under 1700, for example, you can say, you know, I'm going to trade this thing when it's 1700, I'm going to have 100% ETH. And then you could say, well, you know what, let me do 2100 for the upper limit, which then if ETH goes to 2100, you basically have 100% USDC. Everything in between, you're collecting the transaction fees. And for Uniswap V3, there's different trading fees that you can choose from. So you can have 0.05, 0.3, for example, and you're collecting every time someone's buying or selling, you're doing the other side of that trade. That's automated, but you're collecting the fees. And the goal is to have more fees being generated than the loss of ETH moving forward, for example, or if, let's say, you set your band at 2000 and suddenly ETH is at 2100, the impermanent loss basically says, well, ETH can move back down to 2000. So it's not a permanent loss, because if you just allow it to stay active, potentially ETH could go back down into the trading band, and then you can start trading again for fees and basically recover your quote unquote kind of lost opportunity cost. Different than options. I know I've seen that a lot online. It's like, oh, it's like trading options. No, it's not. But it's more of the analogy of a mindset. And I think that's the key phrase here, is that there's different things you can do. You can just keep your ETH in your wallet and do nothing and just hold it and be like, you know what, I'm just not going to do anything. But then you're losing the opportunity to do more things with that. And that's like basically having a checking account earning 0.01% interest. In theory, you can do it, but there's a lost opportunity there. And I think as more people start understanding you can do more things with it, they start experimenting. And I think that's a challenge that very smart people and people that have a lot of ideas will say, oh yeah, I'll try this. And they set the terms and they forget about it, or there's many different things going on. And then they come back and say, oh man, if I just left it alone, I just would have had a much better ETH price instead of selling it for 1600. Like, what was I doing? So I think time and attention is number one benefit of working with someone, because then they can manage and monitor all these different transactions and say, you know what, we need to bump up the band, or maybe we make some modifications, or we have to revisit how much you actually want allocated to Uniswap, because maybe there's other goals and priorities. Like for right now, we're starting to see ETH move. Now might be the time to widen out the bands. And if you're busy with something, or you're like, oh wait, I forgot to do something, then that I think is a key reason why people kind of lose their energy for doing LPs.
That's a great point. And many people watching this will say, well, I mean, sure, if I have some ETH and some USDC in my wallet, they're not generating any yield. But if I'm suddenly providing liquidity to one of these automated market makers like Uniswap V3, I'm taking on additional risk. What are some of the ways to mitigate that risk? Can you add cover for your client's position?
Yeah, that's a great question. And that kind of goes back to, there's always going to be a risk return. And so when we look at using any type of protocol, you're always introducing exposure. Think of it as like kind of using your key to open up a door. There's always going to be ramifications if you start getting, let's say, very vegan and start going into a lot of things that are not really vetted. It could be a legitimate project that just had an oversight or bug, and that has now introduced your wallet. If you start doing transactions with these contracts, you have to know what you're signing. And so I think the first risk is just coding risk, or code risk of just bad coded projects. I remember back to like YAM, I think was, or some of these fruit DeFi LPs back with SushiSwap, there was a lot of these things that just were cloned and they just weren't really vetted, but people were like, fear of missing out. So I think one thing is take a step back and say, okay, the first risk is the fact that you could have a legitimate project with just bad code. The second risk is that you have not a legitimate project with really good code, which just steals all your stuff that you have interacting with the smart wallet. So I think the first thing is to kind of start recognizing your tolerance for how down the rabbit hole you really want to go. I think the first thing is to look at more established projects, and that's where Uniswap is one example that does have what's called smart contract insurance. It's not traditional insurance in the sense of it covering risk up front. So if I kind of maybe share my screen here, I can show maybe some of this. But it allows you to say, you know what, for a certain price, I can start covering or basically having something that would allow me to at least try to get recovered things if something happens. So it actually, this site that I'm on right now is a project called Nexus Mutual. There's other sites that do offer the smart contract insurance. Nexus Mutual was one of the first ones, if not the first one, I think, but it allows you to then kind of look at saying, well, what if there is a rug pull? What if there is a compromise? Well, that's the first thing that I want to point attention to is those are exclusions. That's not going to cover you here. What does cover is more of the actual protocol issues. And so if we have a coding issue or there's an oracle price in terms of there's maybe a manipulation of what ETH is going for example, then that is something that you can say, oh, you know what, I'm going to file a claim. And the other members of the protocol actually decide to vote. So there's actually we can go on the membership side and you can actually take a look at the claims to see what was actually paid out or what was denied and why it was denied or paid out. So this actually kind of shows the voting that's going on with actually real life hacks. So you can see FTX there. So I think this is one of those things that helps reduce probably one of the kind of key risks with smart contracts, with programming, with coding, with Oracle pricing and things like that. There are emerging insurance companies that are looking at what would happen if your account was hacked or there was injected code into MetaMask, for example. So I think we're getting there. We're not there 100% yet, but I think we're going to get there where we're going to have more insurance that can cover the other areas along with smart contract risk.
Yeah, and that'll be fantastic. I know two companies working on this. They're very early in their development, but they're getting there. And so soon enough, we're going to have insurance for both technical issues at the protocol level or even at the network level, and then we're going to have insurance at the wallet level and the user level. So that'll be good. So the nature of our product is non-custodial. So as an advisor, you don't have access to user funds and you don't have discretion, which means that all you're doing is you're sending recommendations, which are ultimately accepted by your client. And to accept them, they have to sign them. How does this work with insurance? Are they buying the insurance themselves? Can you buy it on their behalf? Can you walk us through that process?
Yes. So when I talked to Nexus Mutual, the biggest thing that they had was that there had to be a mechanism that they could identify that there was control over the address that has insurance on it. And what I mean by that is me as an advisor, I don't actually have to have control over the wallet. All I have to do is prove that the person that does have control can prove that they can actually access the wallet. And so what this means is I can't just, and the reason I do this is they don't want someone to start kind of offering insurance or speculating on insurance to say, you know what, I'm going to buy a whole bunch of insurance on SushiSwap. I'm not going to, I don't want to, put anyone down, but let's just like throw out a random project and say, you know, I'm going to buy a whole bunch of insurance hoping that if something happens, then I can go to these people that had claims or would want to claim. And I can say, hey, yeah, I can cover this guy and I'll get it. So they want to have some way of reining in kind of bad behavior. And that's one way of showing that, okay, if there's an advisor and there's a relationship between the client and the advisor is purchasing all the insurance for all these different wallets, then the advisor can then be in charge of kind of ensuring that they can cover all the allocations that are in these different protocols. And so to basically answer your question is anybody can buy insurance for themselves, or they can work with an advisor and have them do it and still cover their own wallet without actually giving over controls. I don't want control. I mean, that's, I think, one of the things from everything that's happening from the regulatory environment is there's a lot of risk and exposure for an advisor if we don't have access. So if somebody is coming out there saying, hey, I want to just let someone do everything for me, that's a lot of risk that I would be taking on to have custody. So the fact that I can kind of operate in this model of just advice only or assets under advisement is a huge win for both client and advisor.
That makes a lot of sense. Let's to wrap up the topic of insurance, let's actually walk through the economics. So we were talking about generating yield by providing liquidity on an automated market maker. Can you walk us through let's call it a stable pair or a not so volatile pair, not so exotic as they call them, ETH USDC. What could a client expect in yield on an average market? Let's call it a sideways market, as it's been over the last year or so. And how much is it? Are we paying for insurance on that position?
Great. All right. So there's a couple of tools that you can use. I mean, one is DeFi Llama to just look for yields, just to kind of say, you know what, let me look at some kind of filters to begin with. I think you hit the nail on the head in terms of saying what can we kind of do to kind of reduce some of the risk. Not, again, there's no way to reduce all the risk, and I think that's the key thing here is even things that are outside of crypto that people think were 100% safe, for example, had issues. I'm sure a lot of folks last year that might have had other family members that were in bonds might have saw that the bonds went down 20%. That to me was more of a shock than somebody that's in something that is much more volatile, seeing volatility. So if your expectation is that this stuff is very volatile, that there's a lot of things that you can't control, but that returns are much higher for that, then at least you understand the kind of the framework and you can kind of work in the right allocation of your overall kind of investments into the different strategies. But that doesn't mean that we can't still kind of reduce some of the risk. So I think audited contracts is one way to kind of kind of reduce some of the things that might be a little bit less, a little more unsure of. I think having at least $1 million in the liquidity pool. More thinly traded liquidity pools tend to shift a lot quicker. So if we have larger pools, there's more assets in there, and it tends to be a little bit more kind of predictable. Not all the time, but a little more predictable. So those are the two things that we can start doing. And the next thing I do is I like to look at the different chains. So I'm going to just deselect all these and just say, you know what, let's look at Ethereum, Arbitrum, just to get started. And there's Optimism too, Polygon.
Which are all supported by L1.
Which are all supported by L1 and can be easily kind of maneuvered with Hop Exchange, for example, or even with Coinbase. Coinbase does allow some direct transfers in and out in ETH or USDC for Optimism and Arbitrum. So it helps kind of reduce some of the friction, if you will, of operating in some of these other scaling solutions.
Right.
So I'm just going to see Optimism. All right. So we'll just kind of look at these and say, okay, you know what? Let's look at average APYs right off the bat. Like you can look at something like Pepe and say, you know what? That's maybe some people want to do that.
A little bit too exotic.
That's kind of like, okay, you know what? We're gonna filter a little bit more. So the next thing we can do is say, you know what? Let's kind of filter to just projects that are on Uniswap V3 for right now. So that's the next thing is we can just say, you know what, we'll just do Uniswap V3, and then let's kind of look at some of these base APYs. I see right off the bat, a few kind of jumps out of me is like Wrapped Bitcoin and Wrapped ETH. So this is one of those pairs that right now you could probably earn about 6% just by trading between two assets that you probably have anyways.
Mm-hmm.
And then right down below, and this is all on Ethereum, so it tells you which chain, and you can actually sort it by base APY. Again, Pepe comes back up. We can never avoid Pepe. So then we can go get down a little bit more and say, if you have like the Arbitrum token, that's about 82% right now. And the base, you can also look at the 30-day average and say that's about 79%. Now, this volatility works both ways, and that's why you can kind of see this doesn't tell you the pricing of these things, but it just says the volatility. So that it can be beneficial in terms of things going up in price together, or it could mean that things are selling, one token is selling off a lot. So you have to be very choosy on what tokens that you're looking to get into. If I was someone looking at this, I would say, you know what, let me look at something like ARB USDC for a little more aggressive. If I'm like more of just like kind of getting started with something, would probably look at more of like a stable, like a USDC wrapped ETH pool. And that's going for about 44% volatility, which is a little bit higher than where it's been historically. So I would say between 20 to 40%. So if we lose, let's say just kind of round down significantly, let's say 20%. All right, so now we're making 20% off of 0.05% fees. That's a lot of transactions that are happening within this protocol. And let's say, okay, I want to buy smart contract insurance. So if I'm making 20%, how much can I get smart contract insurance for Uniswap? And this is where you can start looking at that and you can get a quote. And then I'm not going to put in my wallet here, but basically it would cost you about 1.2% for the year. So if you're generating on average 20% and you're using 1.2% with transactions, and there's different ways of mitigating how many times you have to rebalance. So there's other protocols that kind of work with Uniswap V3 to reduce gas fees, for example. So there's ways of working with an advisor that you can get access to these liquidity pools, especially at a time like now where we're seeing much more of a higher interest. It's going to bring more traders back. It's going to bring back people that want to start buying and selling because they see some sort of trading pattern. I'm not a trader, so that's not my wheelhouse. But for folks that just want to take advantage of the greater kind of liquidity and more volume, this would be a perfect strategy for a portion of their ETH or other assets that you can do different trading pairs with, like ETH OP for Optimism, ETH R, for example, for Arbitrum. So I think those are the ones that might be good ones to look at.
Excellent. That is very helpful. And is the yearly cost fixed? Is it variable? Do you lock it in at the moment of the purchase, or how does that work?
Yeah, so it does fluctuate. It's based off of the track record and what people are willing to kind of insure it for. So the larger protocols, the ones that have stronger teams, stronger track records, for example, Uniswap V3 hasn't had any issues from a smart contract standpoint. So the risk there is, I think, in my opinion, was a lot lower than FTX, right? I mean, you can kind of see what's happening, and none of this stuff is perfect, but at least the transparency is there to say, hey, we need to fix this. And I know that there's other protocols that they support that might be higher. So if we looked at something that might be not as maybe understood, I think GMX is one that might be a little bit higher. Yeah, you're going to look at like a 7.4%.
Makes sense.
But again, for somebody that might be more trading, and they might say, that's inexpensive compared to what I'm doing with that protocol. So it's very much up to each person to kind of decide. I think, working with an advisor, you can kind of hone in on what are the best strategies and how to fit that in the right allocations.
Amazing. And I mean, yes, we're actually adding support for native Nexus Mutual cover and insurance purchasing right from the L1 interface. So not only are you going to be able to send out transaction recommendations on something like Uniswap V3, but you're going to be able to insure those positions right out of the gate. So that's going to be available hopefully very soon. And thank you for your explanations, Nick. Thank you for spending some time with us today. And we hope that this was useful for the audience. If somebody wants to reach you, where can they find you?
Yeah, the best is just to go to ironclad.financial, my website. I have all my information there for the Web3 and how to kind of get in contact with me and how to connect through L1 actually. So I think that's probably the best way.
Well, thank you for spending time with us today. We hope this was useful for everybody watching, and we'll see you next time.